Welcome to this comprehensive revision of FEMA Overseas Investment Regulations. In this session, we'll simplify one of the most important areas for CA final law, overseas investments by Indian residents and entities. We'll cover classification of instruments, investment limits, compliance requirements, schedule-wise provisions, restrictions, restructuring rules, and high-scoring exam pointers. Rather than memorizing isolated provisions, focus on the logic behind the framework. FEMA follows a simple philosophy. Overseas investments are permitted, but only within a carefully regulated structure. By the end of this session, you'll be able to connect the rules, remember the limits, and confidently tackle exam questions. Let's begin with the foundation of the entire overseas investment framework. FEMA follows a principle of controlled freedom. A person resident in India cannot make or transfer any overseas investment or financial commitment unless it is specifically permitted under FEMA, its rules, regulations, or RBI directions. Think of this as a gated community. Entry is allowed, but only through approved gates. An important exam point is that if the original investment itself was not permitted under FEMA, then merely holding or transferring that investment later is also prohibited. So the legality of the initial investment determines the legality of everything that follows. Before applying any overseas investment rule, we must first identify whether the instrument is debt or non-debt. Debt instruments generally represent a lending relationship, such as government bonds, corporate bonds, loans, or depository receipts backed by debt securities. Non-debt instruments represent ownership or capital participation. These include equity shares, LLP capital, units of AIFs, REITs, InvITs, mutual funds, and ETFs with more than 50% equity exposure, and even direct dealings in immovable property. A useful memory aid is simple. Debt means you're acting like a lender, while non-debt means you're acting like an owner or investor. Even when overseas investment is permitted, FEMA imposes an important quality check known as the bona fide business activity requirement. The foreign entity must carry on a business that is legally permissible both in India and in the host country. In other words, legality must exist in both jurisdictions. FEMA also requires any step-down subsidiary or SPV to comply with prescribed structural requirements. Another important restriction is jurisdiction-based. Investments cannot be made in countries specifically restricted by the central government. So whenever you evaluate an overseas investment, ask 3 questions. Is the activity legal? Is the structure compliant? Is the jurisdiction permitted? One of the most student-friendly provisions is the grandfathering clause. Suppose an overseas investment was perfectly legal under the old FEMA regime, but does not satisfy some requirement under the new regulations. FEMA protects such investments. Any overseas investment or financial commitment legally held on the date these regulations were notified is deemed compliant under the current framework. This prevents retrospective hardship for investors. The key phrase for exams is legally made and held as on the date of publication in the official gazette. If that condition is satisfied, the investment enjoys grandfathered protection. FEMA becomes more cautious when dealing with financially stressed or investigated persons. A no objection certificate is mandatory before making a financial commitment or disinvestment if the person is an NPA, a willful defaulter, or is under investigation by agencies such as the CBI, ED, or SFIO. The procedure is straightforward. Apply to the concerned authority, which sends the NOC directly to the authorized dealer bank. However, the most tested exam point is the deemed approval rule. If no response is received within 60 days of application, the law presumes that there is no objection. Whenever equity capital of a foreign entity is issued or transferred, FEMA insists on fairness through the arm's length principle. This applies whether the transfer is between residents, non-residents, or a combination of both. Arm's length simply means the transaction price should reflect genuine market value and not be artificially manipulated. The authorized dealer bank plays a crucial role here. Before processing the transaction, it must ensure that internationally accepted valuation methodologies have been followed. The objective is simple: prevent underpricing, overpricing, and disguised capital transfers across borders. The easiest way to understand overseas investment compliance is through the 5 schedules. Schedule 1 governs overseas direct investment by Indian entities. Schedule 2 covers overseas portfolio investment by Indian entities. Schedule 3 applies to resident individuals. Schedule 4 is for persons resident in India who are neither Indian entities nor resident individuals. Finally, Schedule 5 covers investments into IFSCs located in India. In exams, many students know the provision but confuse the schedule. Therefore, Always connect every rule with its relevant schedule, because schedule identification itself can fetch marks. Schedule 1 specifies the permissible modes through which an Indian entity can make overseas direct investment. These include subscribing to equity capital, purchasing equity, acquiring shares through bidding or tender processes, participating in rights issues and bonus issues, capitalizing legally permitted dues, swapping securities, and acquiring interest through mergers, demergers, or amalgamations. Notice a common theme. Every mode ultimately results in ownership or participation in the foreign entity. FEMA permits flexibility in how ownership is acquired, provided the method is transparent, documented, and compliant with regulatory requirements. This is one of the most important numerical limits in the chapter. An Indian entity's total financial commitment in all foreign entities together cannot exceed 400% of its net worth based on the latest audited balance sheet. However, not everything is included in this limit. Capitalization of retained earnings is excluded. Certain uses of ADR or GDR proceeds and stock swaps are included. ECB proceeds may also be included in specific situations. A notable exception exists for Maharatna, Navratna, and Miniratna public sector undertakings investing in strategic sectors. For exams, remember the figure first. 400% is the magic number. FEMA imposes additional safeguards when overseas investment involves financial services activities. If the Indian entity itself is engaged in financial services, it must have earned profits during the preceding 3 financial years, be regulated by an Indian financial regulator, and obtain required approvals from both Indian and foreign regulators. If the Indian entity is not engaged in financial services, investment is generally permitted except in banking and insurance, subject to profitability conditions. FEMA also introduced a COVID-related relaxation, allowing certain years affected by the pandemic to be ignored while evaluating the 3-year profitability requirement. Unlike ODI, overseas portfolio investment is governed by Schedule 2 and has a much lower ceiling. The total OPI by an Indian entity cannot exceed 50% of its net worth based on the latest audited balance sheet. Listed Indian companies enjoy greater flexibility and can make OPI freely, including through reinvestment. Unlisted entities face tighter restrictions and can invest only through specified routes, such as rights issues, bonus issues, swaps, mergers, or demergers. For revision purposes, remember the comparison. ODI equals 400%, while OPI equals 50%. Schedule 3 governs overseas investments by resident individuals. The overall ceiling is linked to the liberalized remittance scheme. A resident individual can generally make ODI only in an operating foreign entity that is not engaged in financial services and does not have controlled subsidiaries. However, FEMA recognizes special situations such as inheritance, ESOPs, qualification shares, and sweat equity. Investments acquired through these routes enjoy certain relaxations. Another exam point is that acquisitions of less than 10% equity without control through ESOPs, qualification shares, or sweat equity are generally treated as overseas portfolio investments. FEMA draws a clear line around certain structures and activities. A person resident in India cannot create a structure that results in more than 2 layers of subsidiaries where the foreign entity ultimately invests back into India. However, exceptions exist for banks, systemically important NBFCs, insurance companies, and government companies. FEMA also prohibits ODI in gambling activities, INR-linked financial products without RBI approval, and real estate activities. But watch the exam trap carefully. Development of townships, construction projects, roads, and bridges are not treated as prohibited real estate activities. Sometimes foreign entities face financial difficulties, and FEMA permits restructuring under controlled conditions. The foreign entity must have incurred losses during the previous 2 years, based on audited financial statements. Any reduction in value suffered by the Indian investor cannot exceed the proportionate accumulated losses. A valuation certificate becomes mandatory if the original investment exceeds $10 million, or if the diminution exceeds 20% of outstanding dues. The certificate must be on an arm's-length basis and cannot be older than 6 months before the transaction date. As a general rule, acquiring or transferring immovable property outside India requires RBI permission. However, FEMA provides several important exceptions. Property may be acquired through inheritance, purchase using funds from an RFC account, remittances under the liberalized remittance scheme, joint ownership with a non-resident relative, or from income generated from legally held overseas assets. Short-term leases of up to 5 years are also exempt from the general restriction. Remember the golden principle. If the original acquisition was not permitted under FEMA, subsequent holding or transfer remains prohibited. Eventually, investors may wish to exit their overseas investments, and FEMA lays down specific conditions for disinvestment. Transfers through sale are generally permitted subject to pricing, reporting, and documentation requirements. For ODI disinvestment, two conditions are especially important. First, there should be no outstanding equity or debt dues receivable from the foreign entity. Second, the investor must have held the investment for at least 1 year from the date of ODI. These conditions do not apply to certain internal restructuring transactions involving wholly owned foreign subsidiaries, where overall ownership remains unchanged. Before the exam, focus on a few high-yield points. Remember the 60-day deemed approval rule for NOCs. Distinguish clearly between the 400% ODI limit and the 50% OPI limit. Do not fall into the real estate trap. Construction and township development are allowed, while pure buying and selling activities are prohibited. Remember the maximum 2-layer restriction for India-backed investment structures. Finally, for restructuring, recall the twin triggers for valuation certification: investment above $10 million or diminution exceeding 20%. These are the points most likely to appear in MCQs and case-based questions. Let's wrap up this revision. FEMA Overseas Investment Regulations are largely a framework of permissions, limits, safeguards, and exceptions. If you remember the key numerical limits, understand the schedule structure, and identify the major prohibitions and exemptions, most examination questions become straightforward. Focus especially on ODI versus OPI, NOC requirements, restructuring provisions, disinvestment conditions, and the 2-layer rule. Revise these concepts repeatedly and connect them logically, rather than memorizing them mechanically. With that, you've completed a high-yield revision of FEMA Overseas Investment. Happy studying, and all the best for your CA final preparation. Welcome back to our FEMA Overseas Investment Revision series. In this session, we're moving beyond basic investment rules and focusing on the compliance ecosystem that supports overseas investments. We'll cover ESOPs, sweat equity, investments by trusts and societies, IFSC provisions, financial commitments, guarantees, pledges, reporting obligations, annual compliance requirements, and export regulations. Think of this chapter as the operational manual of overseas investment. While earlier provisions tell us what investments can be made, this part explains how they must be reported, monitored, and regulated. These areas are highly important for case study and MCQ-based examination questions. Before diving into individual provisions, let's look at the overall framework. FEMA regulates overseas investments from acquisition all the way to reporting and eventual exit. It covers employee stock options, investments through mutual funds and AIFs, overseas investments in IFSCs, guarantees, pledges, debt commitments, annual reporting, and even export realization requirements. A useful way to understand this chapter is to think of it as a complete life cycle. First comes acquisition, then funding, then compliance, followed by reporting, and finally, realization or repatriation. Once you see the chapter through this sequence, the provisions become much easier to remember. One of the most student-friendly provisions under FEMA relates to ESOPs and sweat equity. A resident individual can acquire shares under an employee stock ownership plan, employee benefit scheme, or sweat equity arrangement without any monetary limit. However, certain conditions must be satisfied. The individual must be an employee or director of an Indian office, branch, subsidiary, or related Indian entity connected to the overseas company. Additionally, the scheme should be offered globally on a uniform basis. FEMA also permits acquisition under schemes launched by the central government. The key exam takeaway is simple: no ceiling, but eligibility and global uniformity conditions must be satisfied. Not every trust or society can invest overseas. FEMA restricts overseas direct investment by trusts and societies primarily to those engaged in educational activities or those operating hospitals in India. The foreign entity must also operate in the same sector. Prior RBI approval is mandatory in every case. Additional conditions include a minimum operational history of 3 financial years, authorization in the trust deed or governing documents, and approval from trustees or the governing body. If any sector-specific permissions are required from government authorities, those must also be obtained. In exams, remember the phrase, education, hospitals, same sector, RBI approval. When mutual funds, venture capital funds, or alternative investment funds invest overseas, FEMA classifies those investments strictly as overseas portfolio investments, or OPI. These investments are governed jointly by RBI and SEBI. While the RBI determines aggregate limits, SEBI specifies limits for individual funds. Another important compliance requirement is routing. Every purchase and sale transaction must be routed through a designated authorized dealer bank. The key concept here is classification. Even if the investment appears substantial, investments by these regulated funds are treated as OPI rather than ODI under FEMA. The International Financial Services Center enjoys several special benefits under FEMA. One of the most important is the deemed approval provision. If regulatory approval is required and the regulator does not decide within 45 days of receiving a complete application, approval is deemed to have been granted. FEMA also relaxes certain net profit requirements for investments into IFSC entities. Contributions to IFSC investment funds are classified as OPI. Another important legal fiction is that a recognized stock exchange located in an IFSC is treated as a stock exchange situated outside India. These special provisions are frequently tested in examinations. An Indian entity can provide financial support to a foreign entity through loans, guarantees, pledges, or deferred payments, but only after satisfying certain conditions. First, it must be eligible to make overseas direct investment. Second, it must have already made ODI in that foreign entity. Third, it should have acquired control in the foreign entity before extending the financial commitment. FEMA treats debt, guarantees, pledges, and deferred consideration as part of the overall financial commitment framework. Therefore, when calculating exposure limits, these commitments cannot be ignored simply because they do not involve immediate cash outflows. Guarantees are one of the most technical yet frequently tested areas under FEMA. Various forms of guarantees are permitted, including corporate guarantees, performance guarantees, personal guarantees by promoters, and bank guarantees supported by collateral. The most important exam points relate to limit calculations. For performance guarantees, only 50% of the guarantee amount is counted towards the financial commitment limit. However, in joint and several guarantees, 100% of the guarantee amount is reckoned separately for each participating Indian entity. Also remember that open-ended guarantees are completely prohibited under FEMA. FEMA allows Indian entities to create pledges or charges over specific assets to support overseas financial commitments. These may include equity of foreign entities, assets located in India, or assets located outside India. The crucial examination point is how the commitment is measured. FEMA adopts the lower of rule. The amount reckoned towards the financial commitment limit is the lesser of the value of the pledge, or the amount of the facility secured by that pledge. Also note that negative pledges and bid bond guarantees are specifically excluded and do not count towards the financial commitment limit. In many acquisitions, the entire purchase price is not paid immediately. FEMA recognizes this commercial reality through deferred consideration provisions. The buyer and seller may agree to defer part of the payment for a specified period. However, the foreign securities must still be issued or transferred upfront. The final consideration must comply with FEMA pricing guidelines. An important conceptual point is that unpaid deferred consideration is treated as a non-fund-based financial commitment. Therefore, even though cash has not yet been paid, FEMA still treats the deferred obligation as part of the overall compliance framework. Once an overseas investment is made, compliance responsibilities immediately begin. Before remittance, the investor must obtain a unique identification number through the designated authorized dealer bank. All transactions linked to that investment must thereafter be routed through the same AD bank. Evidence of investment, such as share certificates, must generally be submitted within 6 months. FEMA also requires realization and repatriation of all dues, including dividends, sale proceeds, and liquidation proceeds, within 90 days from the date they become due. These timelines are highly important for exam purposes. FEMA follows a strict event-based reporting framework. Financial commitments must be reported at the time of remittance or commitment, whichever occurs earlier. Disinvestment transactions must be reported within 30 days of receiving the proceeds. Restructuring events must also be reported within 30 days. For overseas portfolio investments made by non-individual investors, reporting must be completed within 60 days from the end of the relevant half-year. A useful revision trick is to remember the pattern. Major events generally follow a 30-day rule, while periodic OPI reporting follows a 60-day rule. Every overseas direct investment requires continuous monitoring through the annual performance report, commonly known as APR. This report must generally be filed by 31st December every year. FEMA provides certain exemptions. No APR is required where the investor holds less than 10% equity without control and has no other financial commitment. The report is normally based on audited financial statements. In cases of joint ownership, the investor holding the largest stake files the APR. Remember the exam formula. ODI generally means APR, and APR generally means the 31st of December. FEMA takes reporting compliance very seriously. If any required report remains pending, the investor faces an immediate regulatory block. No further financial commitment, whether fund-based or non-fund-based, can be made toward that foreign entity until compliance is restored. Transfers of investments are also restricted. Delays can usually be regularized through payment of a late submission fee, but only within the prescribed period, generally up to 3 years from the original due date. The message from FEMA is clear. Reporting is not a formality. It is a prerequisite for future transactions. Under FEMA, every exporter must furnish a declaration containing true and correct particulars of the export transaction. The declaration should normally state the full export value, and where the exact value is not known, the expected value based on prevailing market conditions must be reported. FEMA empowers the RBI to seek additional information and issue directions to ensure timely realization of export proceeds. An important examination point is that exports are not limited to physical goods. Software transmitted electronically is also treated as an export. The definition further extends to databases, designs, drawings, audio-video signals, and other digital information. Therefore, FEMA regulates both physical and digital exports to ensure foreign exchange earnings are properly realized